Hello friends, welcome back to my channel Finance Unpacked with SB. In this video, I am going to discuss a very rare phenomena that has occurred in past few weeks in the financial world, especially in relation to US market, both stock and bond markets. You see, what generally happens is US is, for traditional reasons, historically it has been always considered as a safe haven. The dollar is considered as the most stable currency, and the US Treasury bonds have always been favorite for the investors, especially the investors of the different current country, like Japan, government of Japan, government of India, government of any other country, European Union, any other country. So dollar has always been a safe bet, and US Treasuries have always been a reliable investment options. So what happens when the stock market falls? Whenever the stock market falls, the money flows from the stock market to the bond market. What does that mean? It means that people sell the stocks, the equity shares, and they purchase the government bonds, the US government bonds. What happens when people sell the stock and purchase the US bonds? The price of the bonds rise. For example, from 100 to 110, 120, 150. But the effective interest rate, also known as yield on debentures, fall. What does that mean? It means that if any government, for example, if US government only wants to raise money at this particular point of time, after the money has flown from stock market to the bond market, the effective interest rate before was, let's suppose, 4.5%. Now, since the money has flown to the bond market, the interest rate has softened, the yield has softened. Now, if the government wants to raise money, they will not have to shell out 6.5% interest rate. They will just be releasing a little lesser, let's suppose 6% of interest rate. So the cost of funds for US government becomes cheap. Now what happened? This in the period, last 20 days period. After US government, Donald Trump, imposed tariff on almost all countries of the world, the stock markets globally crashed. Now ideally, what should have been, the investors across the globe should have taken out their money from the stock markets and invested in the safe haven, which is US Treasury bonds. But what was seen was equally appalling and amazing. There was a huge sell-off in US Treasury bonds also. Now what happened? The interest rate, in our example we have taken, when there is a mass sell-off in treasury bonds also, in government bonds also, the effective rate of interest also increases. Why? Because now the people, the investors, they have less confidence in the US government, in the dollar, that they are safe haven, that they are stable. So they are securing their investment, they are selling of the US Treasury bonds. When people lose interest in a country or in a currency, the rate of interest rise. Now, in order to raise more money, now more interest need to be shelled out. So now the interest rate may have risen from 6.5% to 7%. Just remember, these are hypothetical figures. These are not real interest rate. These are not real US Treasury rates. So now there was a bond market sell-off as well, and the treasury rates have risen. So this is a very rare phenomena where the stock markets also fell, the bond market also fell, and the US yield on treasury rates have increased. Now you know what is the significance of it? See, what Donald Trump was thinking was that when there will be a fall in stock market, people will start buying the US Treasury bonds. When they will buy the US Treasury bonds, the effective yield will fall. When the effective yield will fall, it will be easier for the US government to raise further money in 2026 or late 2025. But it did not happen. The reverse happened. Now, in order for US government to raise money, they have to shell out more interest rate. And that is the reason why there was a 90 days pause on the tariffs. Do you want to know how the bond markets work or how the bonds are valued? What is the relationship between value of bond and the rate of interest? And why our RBI ex-governor, Mr. Shantikanta Das, said that inclusion of Indian government bonds in the JPM Emerging Market Bond Index is a double-edged sword. Do let me know your thoughts around the same and follow me for more such videos. Thank you.